Hello everyone, hope all of you are doing great. This week we will learn about performance evaluation, which is in chapter 10. So, in your past chapters, you actually learned how to do budgeting. So, once you do budgeting, then you have to implement your budget and then you have to compare your actual performance with your budgeted numbers. And this is how you can evaluate the performance of your business. And sometimes, if you have a big business, then you could decentralize your operation and you could evaluate the performance of each segment or each part of your business separately. For example, you can think of uh, Pepsi company's operation, which is a big company, multinational company, and they have business all over the world. They produce different type of products. So what Pepsi could do, Pepsi could decentralize their operation either based on different type of products or based on their geographic area. The main advantage of this decentralization is that your top management does not need to worry about all those activities. They can kind of transfer some of their responsibilities and activities to other managers, and they can also hire different type of expert people, and they can exchange the expertise and knowledge, and they might have better customer relationship and better innovation, and employees will feel more motivated. So these are the advantages for decentralization. On the other hand, you have some disadvantages. Sometimes you will see the duplication of costs, and also there might be some problem of goal congruence. That means if you split up your business, say for example, your decentralization is based on your geographic area, and your company actually does business in Asia, Europe, Africa, and for different part, they might have different type of goals, and there might be some conflicts. So sometimes one potential problem is to achieve that goal congruence. So if you see this type of big multinational company or big business and they decentralize their operation, then you will see that they actually do their own budget and they compare their own performance and they always report those to their upper level management. For example, if you think of this Pepsi company, they did their decentralization based on different type of products. You see, they have soda, they have Gatorade, and they have juice, and they have different type of products. So all these products are subcategories of these PepsiCo America's beverage. And then what they did, just like this beverage section, they have some other sections like Frito-Lays, or you see Quaker Foods, and then they also have one market that actually covers Asia, Middle East, and Africa. So this is how they actually decentralize their system, and all these parts of this businesses, they will do their own budgeting. They will compare their actual performance with their own budgets, and they will report to their bosses. That means ultimately everyone will report to their division managers, and then they will report to the boss or the CEO. So this performance evaluation system actually gives the opportunity to provide the feedback to upper level managements. And if you have this type of system, then that system must clearly communicate what's the expectation of each from each division or from each level of management, and the company or the top management should also provide some benchmark, and there should be some goal congruence. That means whatever the company or the different parts of the company are doing, they should have some consistency among their goals, and of course they should have some intense incentives to motivate their segment managers. So based on their different sectors of their business, they could also identify different type of centers, and we focus here your performance report, and in this performance report you will learn how we actually compare our revenue numbers and different type of expenses between the budgeted one and the actual one. So here we just learned in our past chapter 9, how to do the budgeting. Now we will see the actual numbers, and basically the difference between the budgeted one and the actual one we will call variance. And if you see that any type of variance actually increases your operating income, then we will call it a favorable variance. And on the other hand, if you see that any variance is actually called lowering or reducing your operating income, then we will call those type of variances as unfavorable variances. So the problem you need to do in this chapter will look like this. So for example, this is the same Pepsi company's example, and this is their Midwest sales region, and these are their products. So these are the actual sales numbers, and then you had your budgeted number. So before starting their actual operation at the beginning of the year, the company actually prepared their budgeted numbers. These are their targeted sales, and then they found their actual sales, and then they figure out the differences. So you see the difference, actual and budgeted. So you need to find out the difference, and when you find out the difference, don't worry about the sign. Okay, so just take the absolute value of these differences, which we call variances. Then we will identify which variance is actually favorable and unfavorable. Remember, all these numbers are sales numbers, right? So higher the sales, actually it's better for your company. That will increase your operating income. So if you see that your actual sales are actually higher than your budgeted one, then it will be a favorable variance. On the other hand, if you see the actual sales are lower than the budgeted numbers, then it will be an unfavorable one. For example, if you look at Sun Chips, their actual sales is 2,367,200, but their budgeted one was 2.4 million. So their actual sales is actually lower. So we're gonna call this difference as an unfavorable one. On the other hand, if you pick these Frito-Lay's chips, their actual sales is 4.683,100, but the budgeted one is 4.5 million. That means their actual sales is actually higher by 183,100. So we're going to call it a favorable variance. And then we will express all these variances in terms of percentage. So the percentage means that compared to your budgeted one, what percentage you actually increased or decreased. That means if you take this difference over this budgeted one, then you will figure out the percentages, and of course the notation of your variances or the type of your variances, whether it's a favorable one and unfavorable one, it will be the same thing. So basically this is just a one example, and we just used here the sales number, but you actually need to do like one real income statement type of performance evaluation, and that will look like this. So here you will see Tropicana products. This first column is showing their actual numbers, and the second column is their budgeted numbers, and you see it's actually the entire income statements, right? And of course here we will follow the contribution margin income statement. Basically in this course, in managerial accounting course, and when you are doing all those calculations, numbers, reporting for your internal purposes, we will follow this contribution margin income statement approach. So if you remember from your prior exams that we practiced a lot, contribution margin income statement, we start with our sales numbers, and then we subtract our variable expenses, and then we call it as contribution margin. Then we subtract our fixed expenses. But here you will see one important thing, that when you're going to subtract your fixed expense, you will see that you may have some common fixed expense. That expense is kind of fixed and kind of assigned centrally by your top managements, and usually most of the cases the division level, the divisions actually do not have any influence to control these fixed expenses, right? So what we will do before calculating this operating income and before subtracting our common fixed expense, we'll figure out our segment margin. Right, so I'm repeating, we'll start with sales revenue, then we'll subtract all of our variable expenses, we'll call it contribution margin, then we're gonna subtract our fixed expenses, that segment related fixed expense, we'll call it segment margin, and then we're gonna subtract our common fixed expense, and this is how we will get operating income. So this structure is same, but we will just prepare two columns, and we are actually doing two income statement. One is the actual one and another is the budgeted one. And then we need to find out the difference. And when you're gonna do the difference, remember you don't need to worry about the sign. So just do a actual minus budgeted and ignore the sign, only show the absolute value. And then we will identify by applying our common sense that which variance is a favorable one and which variance is an unfavorable one. So you remember at the beginning we learned that if you see like any item that actually helps you to increase your net income, then it will be a favorable variance. On the other hand, if you see any type of variance actually reducing your net income, then it will be an unfavorable one. So another tip to remember is that any sales or earning type of things, if those are higher, then it's better. On the other hand, if you think of any expense items, then if actual numbers are higher, then it's not good for you, right? So remember, we are comparing everything against the budgeted numbers. So again, for sales, margin, or any type of items that actually increases your operating income, higher is the better. On the other hand, expense or cost items, lower is the better. That means if you see that your difference actual sales revenue is higher than the budgeted one, it's good for you, we call a favorable one. On the other hand, if you see any type of your cost and expenses, actual numbers are actually higher, then it will be an unfavorable one. But if you say actual numbers are actually lower, then it will be a favorable one. For example, if you see variable cost of goods sold, which is of course an expense, and you see the actual is 1,728, on the other hand the budgeted one is 1,720. That means their actual cost of goods sold, variable cost of goods sold is higher than the budgeted one. So your actual cost is higher than the budgeted one. Of course, it's not good for you, right? If your expense is higher than what you actually planned or expected, then you'll not be happy, right? And that's why we'll call this difference as an unfavorable one. On the other hand, if you find that any type of expense which is actually lower than the budgeted numbers, then it's a great news. Then it will be a favorable variance. For example, if you see here variable operating expenses, this is 508. That's the actual number, but your budgeted one is 515. So your budgeted expense was higher, but your actual expense is lower, which is good. And of course, the difference, which you found 7, will be a favorable one. Again, you can also express everything in terms of percentage. So the percentage, to express those percentage, you have to take this variance and then you have to divide it by the budgeted number. For example, sales revenue 14 is the variance number and the budgeted is 4,300. So 14 over 4,300, you will get 0.3%. So this is how we will do this performance evaluation with segment margin approach for our actual and budgeted ones to compare the performance. Now, to evaluate your performance, we will also use some other ratios. We call it ratios. So one of the most important one is ROI, return on investment, and another is the residual income, RI. So now let's see how you can use those numbers. And you actually need to memorize this formula, but there are several tips how you can memorize those. For example, ROI. It says return on investment. So we basically invest in our assets, right? So when you need to calculate this ROI, your bottom part of the denominator will be total assets. And on the other hand, return means operating income. Right. So if you invest in your asset, how much income you are making from that asset, that income will be in one sense your return. So ROI, to calculate it, what you need to do, you need to take operating income and you need to divide it by total asset. This is how you will calculate your ROI. Now this ROI, we can decompose this formula. How? So let's take the operating income here, the top part, and divide it by sales. And then here take again sales and divide it by the bottom item, which is the denominator item, which is the total assets. So basically it's the same thing. If you compare these two formulas, these are the same things, right? Because if you cross out this sales, it will be cancelled out. So it's basically the same formula, but we can decompose it, we can break it out, and this first part will call it sales margin. So basically, what's the formula for your sales margin? It's operating income divided by sales. Sales margin. What's the margin that you are getting from your sales? Return margin, or you can call all those are kind of the number of income, the number that tells your income. Right. So sales margin, the formula is operating income divided by sales. On the other hand, capital turnover, this formula we know it also as capital turnover. Sales divided by total assets. So that means ROI, this is the short formula. You can also decompose it into two parts, sales margin over capital multiplied by capital turnover. And sales margin means operating income over sales, and capital turnover means sales over total assets. So you basically need to know all this formula. Then the other item we need to know is called residual income. So these numbers actually tells you whether a specific division has created any excess or residual income above the manager's expectations. So manager may set you some certain target, and then you have to check what's the actual operating income and how much extra you actually made on top of that targeted income. So this is the formula. Residual income equals to operating income minus target rate of return times total assets. So basically you will know what's the total asset of the company, and you will also know what's the target rate of return. So if you use this target rate of return and you multiply it by total assets, then you will find your minimum acceptable income, and then you will compare this one with your operating income, and this is how you find the difference, which you're going to call your residual income. So there are several measurement issues. We need to think of it, what type of balance sheet information we will use. Should we use all assets? Should we take this book value, or should we take net book value? So do we need to do any type of adjustments? So these are kind of like a very deep analysis. You don't need to worry about it, but try to understand that this performance evaluation is really very important for managers. They actually compare their actual performance against the budgeted numbers, and depending on that, managers are kind of evaluated. They get incentives, they may get bonuses, or they could be fired, right, if their performance is really bad. So sometimes managers may be tempted to take like very achieve some short-term goals, right? So if managers try to achieve some short-term goals, either just because of their bonus compensation or incentives, then maybe it may be bad for the company. So when we need to incentivize the segment managers, we need to think of what's the long-term goal of the company, what will be the best for the company in the long run, not in the short run. So that's all about chapter 10, and of course we'll practice some problems.